All right. Welcome, everybody. Welcome to Master Your Money. On today's episode, we have my colleague, Greg Wachter, with us. Greg is the Vice President of Risk Management here at the firm. And what Greg does all day, every day, is he works on the risk management side of financial planning. In addition to that, Greg is a Finseca ambassador. He's a member of Finseca, which is an advocacy group for life insurance. Finseca focuses on providing financial security for all. In addition to that, if that's not enough, Greg is also on the National Committee for the Regulation of the Index Universal Life, AG 49. Holy smokes, that means he's really smart. He's really dialed into the risk management business, and he knows his stuff. So Greg is going to share his good work with us. Greg is going to share his knowledge with us. And Greg is really going to talk about how folks need to think about building a buffer for themselves when it comes to retirement planning. That's where we're going to spend the bulk of our time today. So Greg, it is my pleasure and honor to have you here. I'm so excited about this episode with you.
Thank you, Elizabeth. I'm very happy to be here.
Good. You have to stop and tell us a little bit about what was in your intro. Tell us about Finseca. Tell us about this committee that you're on and the work that you do there.
Yeah. So Finseca is a life insurance advocacy group. And I've been going to their conference now down in DC for about 6-7 years with obviously a break for COVID. Mm-hmm. It was formerly AALU. And we go down and honestly lobby through different senators and different politicians for the laws of life insurance and the taxation of it to not change. It's pretty funny. We're one of the few people or lobbyists that go into these offices and say, don't change anything on the life insurance taxation, because it is something that does come up in conversation here and there. But just so everybody knows, there's nothing that works right now. But again, go down, lobby for the industry, make sure that our voices are heard, because politicians don't always know everything about the life insurance industry. So we got to make sure our voices are heard.
And acting on the voice of the consumer.
Exactly.
All the clients, the hundreds of thousands of clients that we all work with.
Exactly. And that's a lot of what we tell them, and it's not just the ultra high net worth that are just looking to make sure they're taking care of an estate plan, or a very wealthy person. It could just be that young family that's starting out. Mm-hmm. And the way things are set right now are very good for these families, and making sure that if something does happen, that their family will be okay.
Yeah. And you want to keep it that way.
Exactly.
You want to make sure that again, that you can provide that financial security for all.
Exactly.
I love that. That's amazing, Greg. Thank you for all the work you do there.
Love to do it.
Tell us about what you do for the clients of Barnum Financial Group. What does it mean to incorporate risk management into that financial planning space? Yeah.
So obviously risk management is a very broad spectrum of things that can fall under that umbrella. I mainly work in the life insurance space and long-term care space. Mm-hmm. And really for the clients we work with, again, from the very basics of, God forbid something happens, want to make sure their young families are protected, making sure that if they put a retirement plan in place with one of our financial planners, that God forbid their income isn't there or something happens, that the plan is still self-fulfilling. Mm-hmm. So naturally on the risk management side, we're more on the protection and making sure that all the other good work that you're doing to get to a certain goal, retirement, college, buy a second home, first home, whatever it may be, we can make sure that actually happens. Whether or not you're able to earn the income or not. So the foundation, if you will, Elizabeth.
I love that. Good. Everybody needs a solid foundation for sure. But making sure, I think you do a lot of educating. And there's a lot that people do not know about life insurance and about risk management. Yeah. And being on the forefront, starting at legislation, you know a lot more than the average person about this topic.
Yeah. And it's not just the lack of information or lack of knowledge that's out there, but it's also a lot of misinformation that's out there. And, COVID was a blessing and a curse for our industry. And I think one of the blessings is that there's so many more videos and there's more content out there for people to see. Mm-hmm. Also, one of the curses is that there's more videos and more content out there for people to see.
People are self-educating.
Exactly. And look, I think they're great. And a lot of them are very sound videos. But there's also a lot of them that are out there that might not be so perfect. And it's hard filtering through a lot of that.
It absolutely is hard for the average person to filter through that. And I think a lot it always depends. I feel like we use that term so often that everything depends on where you are today, what your objectives are, what you value, what you find most important. And I think that's where you play such an important role, because you can educate people on where life insurance, risk management, all those strategies can fit into what people depend on.
Exactly. And there's so many different, obviously, insurance carriers and insurance products and different things that these products do. We always say the product is the easiest part of our job. Learning to discover what you're trying to do, how you're looking to do it, and what goals and concerns you have. That's the hard part.
Yes.
And once we get through that, the products fit into place.
Yeah.
Because, even though we hang our hat at one insurance company, we have access to almost the entire industry. So if one particular product doesn't fit from one company, or there's a certain underwriting niche at another company, we'll make sure we take advantage of that and shop the industry around.
I love that. And to that point, nothing that you do is standalone.
Nothing.
Every product, every strategy should fit within a long-term plan.
Exactly. And there's so many ways to go about structuring products and designing them for different things. And we might use the same product for 5 different clients, structuring it all completely different, have different goals, and they serve different purposes. But it's finding out exactly at the root, what are we looking to do and why are we looking to do it?
Yeah.
And I say to clients all the time, I say, look, I'm here to talk about your life insurance and this side of the protection space, but I'm not here to sell you a life insurance policy. I'm here to make sure that the insurance conversation we're having fits within your overall financial plan, and that it's not just shooting from the hip and saying, hey, here's 4 or 5 options, take your pick. It's, no, let's see why and how this works with your plan, and ultimately what kind of flexibility it has down the road as well.
I love that. How do people typically react to that type of conversation?
Interesting question, Elizabeth. We get a range of reactions.
Yeah.
There's a lot of people that say, I saw this video and this video is gold and the Bible here, and that's it. And there's other people that are, I saw something out there. I'm looking for confirmation and making sure it's, we're looking at is correct.
So they want you to validate.
Exactly. So always have to validate. And I say to everybody I talk to, I'm like, we're going to go through high level, a lot of strategies, but the fine print of these things are the most important part of this.
Yeah.
Because that's what people don't talk about.
Yeah.
So, a lot of times agents, advisors will talk about the positives of a product or how it works in one particular way, but not get into the nitty gritty. And with insurance, you kind of have
those
to.
Details
Exactly.
matter.
Exactly.
Those details
they
matter.
really, really matter. Yeah.
But it seems as though people are open. The majority of who you're speaking with is open to the concept of incorporating risk management. It's just which strategy to incorporate it and how to maximize possibly something that they already have.
Exactly. And we've been seeing, at least I've been seeing more and more engagement from the general public versus advisors reaching out to clients, which obviously still happens, but we've been seeing a lot more inbound calls and a lot more people that are actually seeking the advice. So, whether these videos out there are the best or not that great or work, it's still driving people towards the industry.
And listen, I think we all love an educated consumer.
Yeah.
It's great when people come with a framework of here's what I know, here's what I think I know, and then you get to fill in the blank with your expertise. That's smart.
Yeah, exactly. And we look to have a conversation, and even after the first time we meet, we'll come back with some recommendations or maybe continue that conversation. But we'll say we come back with recommendations, and I'll always say, Elizabeth, I know we got to know you last time, but that was a 45-minute conversation.
Yeah.
We may have missed something.
Yes.
Something may have changed.
Yes.
We might not have hit every single nail on the head.
Yes.
So what we're going over today, it might change for our next meeting, but I just want feedback from you. I want to make sure that what I'm showing you is accurate and I did hear you correctly.
Yeah.
Or if there is something that we missed, fine, but let's take another week to do this. It's a huge decision.
It is a huge decision.
And we don't want to rush these decisions.
And there's no reason. Right. You want to make sure you have the coverage you need and the plan you need, but it needs to fit with where you're going.
Exactly.
That's amazing. But speaking of being smart and speaking of doing the right thing, I heard you speak at an event and you and a colleague of yours just did an amazing job talking about building a buffer, building a buffer within your retirement plan. And I just thought it was fabulous. And that's what motivated me to bring you on the show today, because I know our listeners have to hear this strategy and there's no better person to explain it. So can you talk about that?
Yeah, I think it's building a buffer. It's an in my opinion, a strategy that's not talked about enough, or if it is talked about, it's very speculative in some cases or for some clients, because to our previous point, the education is not always there. So what is it? It's part of retirement planning, and it's carving off a portion of your savings each year, each month, however you save, to build an asset class that is a non-correlated market asset. And what that means is an asset class that doesn't move in the same directions as the stock market and going up and down. We know we need to be in the stock market for that upside potential. Obviously, as long as you're willing to take the risk. And it's proven over time that it works. And we need to outpace inflation and make sure we keep up with our growing expenses and everything else. But we also need to protect against those down years in the stock market. And in retirement, the earlier that might happen, the more impact that could have on the longevity of your dollars.
So to simplify, because I'm not as smart as you are, Greg, we are not putting all of our eggs in one basket, right?
Exactly.
This concept, it's essentially part of asset allocation.
Exactly.
Correct?
Yeah.
You're just diversifying where you're putting your money, so you're not tied to one thing.
Exactly. And we talk a lot about accumulation versus decumulation in the financial planning process. And when we speak with clients, a lot of times we're talking about the accumulation process. We're getting them towards that retirement or towards that goal that they're looking to attain. And I'll ask you, would you rather get a 5% rate of return or a 7? 7, of course. Everybody would. Would. So during the accumulation, I'm always
smart enough to know that, Greg.
Exactly. So we always want as much rate of return as we can during accumulation. It makes sense. I do too. But we also, when we get to the decumulation process, as much as we still want to get as much return as we can, we tend to get a little bit more conservative, right? Towards retirement, we don't need to take as much risk. But what we've learned over the last 20, 25 years is that these long-term market cycles of big market crashes are becoming more short-term market cycles. Saw it in 2002. We saw it in 2008.
They're happening more often, but they're shorter.
Exactly. But they're still just as severe, if not more severe.
Especially if you're planning on retiring that year.
Exactly. So, I say to people all the time, I'm like, 2008, it actually helped me, right? And I hate to even say that, but and I'm not saying that I wanted it to, but that's when I graduated college. That's when I started investing money. So I just got lucky that that's when I happened to graduate. So it's investing at the bottom. But the people that were most impacted by it were the people that retired in 2005, 2006, 2007, 2008, 2009. Because the earlier you see a big market downturn during your retirement years, the more impact that has on the longevity of your dollars. So there's been a couple different studies out there, some by some big mutual fund companies, others by actually some accounting firms, which is great that it's not even in our industry, that goes through this sequence of returns risk and why it's an important thing to look at and be concerned about. Because when we're accumulating dollars, if we have 3 different portfolios, as long as they average the same return over the same time frame, it doesn't matter how we get our return. Whether it's -7, +14, -7, +14, or a straight 7. We end up with the same amount of money during the accumulation. But then we start taking money out. That's where these downturns will have a huge impact.
Not to interrupt you, but can you back up for 1 second?
I get excited, Elizabeth. You sometimes
I love it, Greg.
Oh,
Greg, I love it. Everyone loves it. But can you slow down for 1 sec? And can we break down the accumulation phase and the decumulation phase? Can you go into who is in which phase, what you should be doing in each phase, and why this matters in each phase?
Perfect. So the accumulation phase is naturally, like how it sounds, we're accumulating assets for retirement.
Making money.
We're trying to make money. We're trying to grow that money. And we know that you have to do that over a longer period of time. You should be doing it.
You want to do that for as long as humanly possible.
That guy, that pretty smart guy, Albert Einstein said.
Heard of him?
You heard of him. Once or twice. Know him. Compound interest is the 8th wonder of the world. And the biggest thing with compound interest, the one thing you can't control is time. Time goes and we know we can't go back. So compounding, 1 doubles into 2, 2 doubles into 4, 4 into 8, 8 into 16. And those doubles happen bigger and bigger and bigger and
as
bigger.
Time goes.
Right. So the younger generation of getting out of college into your 30s and 40s, that's definitely a part of the accumulation phase. 40s into 50s, even into 60s, into that retirement time frame. Basically, those people, those individuals that are not in the retirement space yet.
I was just going to say, so essentially we're talking about this, the minute you are old enough to start earning an income and you have regular income that you could set money aside for, you need to start accumulating all the way up until you retire.
Yeah.
Everybody is in that phase.
I'll tell you that looking back, the first day I started here at Barnum and graduated college, had a lot of student loan debt, had no money, living with my parents. Sure. All I'm worried about is, all right, I need to start saving some money. Sure. Or I need to start paying down my debt. Yeah. My manager comes over to my desk and he goes, Greg, open up your portal. I'm like, why? He goes, just do it. Go click on 401k and click on 2%. Yes. I'm like, what do you mean? I haven't made a dime yet. Yes. What do you mean save for retirement? Yes. I'm 22 years old. This is insane. He goes, just don't argue with me. Do it. And I promise you'll be happy. And put this 1% increase on each year. Didn't even notice it was happening. Yep. And before I knew it, I was actually saving 10%. Yes. So going from 2 to 3 to 4 to 5 to 6 and all the way up is a lot easier than going from 0 to 10%. 100%.
It's so funny, not to interrupt you or to digress, but it's so funny you say that because that's exactly how I started saving for my retirement. Paul, the CEO.
I was forced to,
Yes, Paul, the CEO, did the exact same thing to me. Yeah. I didn't even know what I was doing, but I didn't miss the money. And because I was young and at that time, I didn't have as many expenses as I do now. And I am eternally grateful that I did not miss all those years of compounding. So that's great. That's great that we do that. So everyone who's listening, make sure you have those, make sure you have that faucet turned on for yourself.
Exactly. Have to do it.
Good. Okay. So accumulation is everybody who is working, taking advantage of compounding. So we're accumulating all of our wealth. Okay. And talk about the other phase, decumulation.
Yeah. So decumulation, actually just the opposite. We've accumulated all these assets. We've saved money just to get to that point of, I don't have to show up to work every day. And now that is my income. Now I'm living off of those assets and I need to make sure that those assets are going to last my lifetime.
So we're earning money. Now we're spending.
Exactly. Okay. Exactly. And you work for 30, 35, 40 years of your life, and going back 30 years ago, you would probably be retired for 15, 20 years, maybe a little further back than that. Mm-hmm. But nowadays, people are retired for just as long as they're working, if not longer.
Yes.
So protecting those dollars, especially earlier on, is super, super important, because I don't think people are going to want to go back to work at 88 years old just because we weren't set up properly at the beginning of retirement.
You didn't have that plan in place. So how does building a buffer do that? So you're taking a pool of that accumulation and you're putting it outside of the market. So get into more detail there.
Yeah. So the concept of building a buffer is, first off, it doesn't happen overnight. It's not something that is just going to appear. It's something that you want to build up over time.
So this isn't a strategy to use when you're panicked.
Exactly.
When you realize that retirement is in the near future.
Exactly.
When should one start thinking about this or building this process?
I mean, obviously, it's everybody that's not retired is the blanket answer, but more realistically or ideally, that age 35 to 55 range is probably the most ideal for it. But again, doesn't mean that that's the only age range.
To maximize it, to get the full benefits of it. That's the best spot.
Okay. We've noticed that 35-year-olds are kind of past those partying years and starting to build a family, starting to have income. Exactly. The income is there. After 55, it is definitely still doable. Just might have to take a different approach to it.
Okay.
But in essence, if we're looking to carve off a portion of our savings, 10, 20, maybe 30%, but more like probably 15, 20%, and put it into an asset class that is never going to get a 25 or 30% rate of return, but it's never going to get a negative rate of return either. So it's an asset that non-correlated with the market. We see the market go up and down. This is just a slow and steady, I like to even say boring rate of return each and every year.
Well, so there's nothing wrong with slow and steady. I hear that wins the race.
The turtle. Does pretty good.
Yes. So there's nothing wrong with that, right? If you have the time.
And the other part is, we're not looking to over allocate into this and miss out on a lot of the upside potential that we know the stock market could give us.
Yep.
But there's, again, many studies out there, one more recently by I've mentioned it before, a big accounting firm that did a study on 35-year-olds, 45 and 55-year-olds.
Yep.
And what they did was they took these different clients and said, what if one of them just had investments only, no buffers? The second client had a 10% buffer. the third client had a 20%, and the third client had a 30% buffer. So there is another part of the article that I'm not going to get too much into right now. But basically the overall analysis from it was between the 20 and 30% savings into a buffer, even going back to the 35-year-old. Because again, most of the younger people are thinking growth, maximize, right? Which, yes, you do want to do, but carving off 20 or 30% ended up giving those clients not only more retirement income per year than the investment only strategy, but they had more peace of mind. They had more freedom to not have to worry because they had this buffer there. So the emotional side of it, and they ended up leaving more money to their heirs. So more income, more money left over.
Less worry. A lot of people think you retire off of the assets that you accumulate, which is true to an extent, but in reality, it's the income that those assets can derive for you to make sure that you have that steady stream of money coming in. And the growth of those assets over time.
Exactly.
And you touched on something really important, the emotional side of, I like to talk a lot about behavioral finance and the psychology of why we do the things we do, but the emotional side of investing and having all of your money tied up in the market. We've seen firsthand that is tough for a lot of people. It's
tough for a lot of people.
It's tough for a lot of people that worry, not knowing what to do, feeling a little bit kind of out of control in those moments.
Yeah.
That's really difficult. And this seems to building a buffer should provide some peace of mind against that.
Yeah. And even during the accumulation years, the way the money grows inside of this and the way it's invested doesn't change. So it still is getting that predictable rate of return and never losing money. So even during the accumulation years, when we see a big downturn, instead of getting scared, pulling all of your invested money out because I can't let it go down even further. It's, I know I have this chunk here. And for the people that really want to take advantage of it, they could even use that money and invest it into the market at the bottom and pay back their buffer strategy a few years later. So the more you're in tune and understand how the buffer bucket works, the more you'll actually take advantage of it, not only in retirement, but throughout your lifetime. Right.
Exactly. It's not set it and forget it.
It's not just this, the money's not going into a black hole. To be honest, it actually has more flexibility and more access than a regular retirement account.
Well, that's what I was going to ask you next. I'm curious if you can share examples or strategies or case studies of where does that pool go?
Yeah. So there's a few different ways that you can build this buffer bucket. The one in particular we're talking about today is utilizing a whole life policy. And, I say the word whole life and a lot of times there is a stigma around that word because of 30, 40 years ago in the industry. Nowadays, these products are really structured for the accumulation and having the income coming out, not as well as the protection. Obviously, we know that the death benefit is there too. But it's a whole life policy that is structured to be paid up over a certain period of time. And that's not an opinion. That's not you might be. That's on a contractual guaranteed basis. 20 years, you're done.
And you know, 65, and you know that done when you purchase the policy.
Correct. And that's going back to our original conversation in the beginning. That's where we talk about what are you looking to accomplish? What are your goals? What are your concerns? Just because we're talking to somebody that's 40, we can't just assume that they have 25 years, 26 years until retirement. They might be retiring at 55.
Sure.
Right. So we want to make sure we structure the products to correlate with your goals. And the important part of that is there's no drag of the policy at all once you're done paying for it. There's no extra premiums or anything coming out that's being paid by the policy. It is truly contractually guaranteed.
After X amount of years, you're done.
Correct.
And then is it building value from there?
Yeah, it continues. It's building value over the years. And then to be honest, the premium's done. That's really when it starts to grow the most.
Yes.
So, we typically look to structure something that is paid up at 65, for your traditional retirement time frame, or, 12, 15 year period, 20 year period. Honestly, like I said before, product is the easiest part, but knowing that there's different products out there to serve different purposes is the main point of this. And then during our conversations, we then dig in to see, okay, which of the plethora of products we have that fit within your strategy,
which whole life policy or
exactly.
Exactly. So how does that money grow for folks if it's not tied to the market?
Yeah, it's actually pretty interesting. There's two basically buckets of money that's inside. Now to you, it looks like just one pool of cash, but in the background of things, there's really two buckets of money. There's one bucket that is based on a guaranteed interest rate. So it's one of the few policies and also investments out there that even in a worst case scenario possible, I could still guarantee that you would have some dollars in the future.
I'm sorry to interrupt you. I love that you positioned it that way, because you don't usually make that correlation with insurance. You think of it as part of your investment portfolio.
No, not a lot of people do. And again, that's why we like to take the time to educate on the why behind it. And, you still do need to have a need for the life insurance in some way, shape, or form. So you can't just say, oh, I want to use this just for investments. But the death benefit obviously does have a big play in this space. But
two buckets. I'm sorry.
Two buckets. Yes. Two buckets. We have our guaranteed cash value that's growing. And again, depending on the product will depend on the guaranteed interest growth rate. Okay. And then there's also a dividend that's similar to a stock dividend, but it's a mutual company. So there are no shareholders, there's policyholders. Mm-hmm. And the dividend is paid into your policy. Mm-hmm. And that helps to grow the cash over and above the guarantee.
Wow.
So it's about at the foundation, you have guaranteed cash value growth.
Yes.
Right? You have a guaranteed investment.
Yes.
And then
that you know of ahead of time.
Exactly. And not to mention the dividend has the carrier pays. So, a lot of these carriers are mainly mutual carriers that offer these products. Mm-hmm. They've been around since 1850, 1860. Mm-hmm. And I actually just heard an interesting fact the other day. One of the carriers has been paying a dividend longer than the light bulb has been invented.
No way.
Yeah, it's pretty crazy, huh? So it's something that we can't guarantee that'll be paid because no dividend is ever guaranteed.
Of course. But if you look back historically, chances are pretty good. Yeah. Chances are pretty good. Yeah. Oh, that's great.
Yeah.
So is that one way of pooling those funds? Is there other strategies you recommend, or is it mostly whole life and then you go from there?
Yeah. Well, here at Barnum, we work in teams and mm-hmm. each specialist kind of has their own space that they work in. Mm-hmm. So when I'm brought in, that's mainly the area that I work on. But mm-hmm. there are other annuity products and some other investment products out there that can help in the buffer strategy. Mm-hmm. But one kind of portion of this that I can't believe I forgot to mention, not only is this money non-correlated and you have access to it, but you get tax-free distributions. So
that's a big one, right?
I know. It's one of the biggest points of this. And one of the reasons why we look at it.
Engaged. Yes, I forgot about that.
So they're tax-free distributions. So we talk about diversification. We talk about mm-hmm. saving money. We talk about investments and products and things to utilize. But there's also tax diversification as well.
Yeah, there's tax strategies.
Yeah. So today we save into our 401k, IRA, 403b, 457, whatever it may be, to get tax savings immediately.
Yeah.
If I make $100,000 today, I put 10 grand into a 401, I'm only taxed on 90,000.
Yep.
In this bucket, if I make $100,000, I put 10 grand in, I'm still taxed on $100,000 this year. But now fast forward 25 years.
Yep.
Now we're taking money out. All those IRA and 401k dollars are taxed at whatever tax bracket you're in at that time. People ask all the time, what's my retirement tax bracket? There is no retirement tax bracket. Yeah. It's whatever your tax bracket is at the time. So the tax-free bucket or the buffer bucket, now we're pulling tax-free dollars out. So this is a way to control your tax bracket in the future.
Yes, you're paying the taxes where you are today, not where you will be. And chances are taxes don't really go down. I haven't seen. So chances are no matter what, you're going to be paying more later.
Most likely.
Greg, what about indexed ULs? What about IULs?
Yeah. At the core, they're structured. They're very good policies. I think a lot of times they're positioned incorrectly and can be utilized, but there is a little bit more risk that's associated with them. Mm-hmm. So we talked about the sequence of returns risk before with when you're retiring, you take money out. Early downturns have a big impact on the longevity of dollars. If I'm 30 years into retirement and I see a downturn, obviously it's going to impact you, but most likely you'll still be okay and the longevity of your dollars will be okay. With indexed universal life, it's the same conversation. So we look at an illustration, it says 6% return every single year. Great. Do I think you'll average more than 6? Probably. But what that's showing is what we refer to as a linear 6%, which means 6, 6, 6, 6 every single year. But IULs returns are mainly comprised of caps and floors. And what that means is when you're investing in here, they're going to let you return a certain amount, let's say 10%. Anything over the company keeps. So then on the downside, if you get a 0% return, you don't lose any money. So that's where a lot of the conversations stop. But the real statement is you don't lose money due to market exposure. You still lose a lot of money due to fees and expenses inside of the policy. So depending on when you see that downturn, and honestly, Elizabeth, if you want to have another 45-minute to 6-hour conversation, we could get more into that, but I'm going to keep it really high level for now.
Okay.
So when you have these caps and floors and you get a 0, in some policies, you're still going down by 4 or 5%.
Yeah.
So if that happens and we're capped, it might take you 2 or 3 years just to break even on those dollars.
Yes.
So if you're in an IUL and you get lucky and your segment ends at a very high rate of return, you'll get a high rate of return in your policy. But the people, like for instance, that had policy anniversaries in March of 2020, big COVID crash.
Yeah.
Not looking so good.
Not looking so good.
A month before.
Yeah.
Policies look better.
So
right. So it's all about timing and not as safe as they're meant to believe.
That's great information. And we should talk more about that, because that sounds like something that we need to shed some light on.
Yeah.
So not a strategy you use when you're building a buffer.
No. And again, I do use those products in certain cases. Yeah. I just think for this particular strategy, the mechanics of the product just aren't there. You do have more upside potential in a lot of cases, but for what we're trying to build in this, let's get our upside potential in our investments. Let them do what they're supposed to do.
Yep.
Use this for not only your protection.
Yep.
You want to know it's there with guarantees, but also building that buffer asset that is very, very predictable. Very predictable.
That's what we want out of this. We want peace of mind.
Correct.
So before we wrap up, Greg, just why wouldn't somebody do this? Or what are you up against?
Yeah.
Is there a fear here?
So I think it's a couple things, and we definitely touched on some of them. Number one is unaware or misinformed.
Okay.
Again, it's just not even knowing that it's possible. And like your reaction in the beginning, using life insurance as an investment, like that's crazy.
It's crazy.
A lot of people say that's crazy talk. But it's something that can be a part of your portfolio when positioned properly and when utilized properly.
Yes.
Where people get into fear of this is when they were told one thing of how something was going to work, obviously being very vague, and then it didn't work in that particular manner. So again, educating and understanding the why and the how behind it and knowing what we're looking to accomplish, but mainly just getting more educated about it. And that's what obviously we talk about. Second one kind of is said it again before is the stigma. Just like the stigma of whole life in general. But again, these products really have changed over the years and they've really been a lot more focused, especially after the big change in beginning of 2022 with the tax code for insurance products, much more cash value accumulation focused. But again, it's setting the right expectations and knowing the why. I promise you're never going to get a 25% rate of return, but that's not the point. The last few are balance. Do I pay off my debt? Do I save for college?
Yes.
Do I save for this? Do I save for that? What do I do?
Yes.
And I will say one of the nice things about this is that you could earmark it for one specific purpose, like building a buffer in retirement.
Yep.
But if you're 10 grand behind on college and you want to pay your daughter's college tuition, you could take 10 grand from yourself and again, either pay yourself back. Yep. Or don't.
Yep.
Right. So it's very flexible there. And the last two, people think it's too late. Right. We talked about that 55-year-old, 56-year-old, but it's really never too late.
Never too late.
Especially if you're not retiring until a little later.
Yes.
But there's always most of the time a way to build out something.
I'm so glad you mentioned that.
Yeah. And really that's a lot of the conversations we have. It's just too late, or they just don't think it's worth it.
And I would imagine, Greg, those are phenomenal benefits and really difficult to argue with. This isn't something you should try to go alone.
No, again, I always encourage people to do as much research as they can.
Yeah.
But the hardest part about doing research on these topics are finding is what's fact and what's opinion out there. And unfortunately, there's a lot of opinion. And I obviously have my own opinions as well about things, but I base a lot of my opinions about this on facts about the products.
Yes.
And again, just understanding the true mechanics and behind everything of the why is really why I'm here, and to make sure that you do understand. And if you are educated, understand, and don't think it fits, that's fine too.
Yes.
You know, that happens too.
And working with a professional like yourself, a financial advisor, is just part of that education.
Yeah.
That should not be overlooked. So going to an advisor just to implement probably isn't in best interest, right? Get information, come with your values, come with your goals, and make the decision together.
Yeah. And I know we're still working on it, but I think I'm actually hosting a seminar that's going to be open to the public in the next couple of months.
Amazing.
On this topic and getting a lot more granular into looking at some visuals. And so I'll definitely let you know when that happens.
Yes.
And we could get it blasted out to everybody. So if anybody wants to learn more and get on,
yes.
love to have people on.
Yes. Everyone keep checking the Barnum Financial Group website, barnumfinancialgroup.com for information on that. But that's wonderful, Greg. It's been amazing having you on. I love this conversation. Thank you for all the great work you do in this space and for making sure that we all can maintain financial security.
Thank you for having me, Elizabeth. I would love to come back sometime.
Oh, my pleasure, Greg. Thank you for listening to Master Your Money. Please rate, review, and subscribe on Apple Podcast, Spotify, or wherever you listen to your podcast. Every little bit helps. You can also follow us on our Instagram at Barnum Financial Group.
All opinions expressed by the program participants are solely their current opinions and do not reflect the opinions their respective parent companies or affiliates or the companies with which the program participants are affiliated. Investments or strategies mentioned in this program may not be suitable for you, and you should make your own independent decision regarding them. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as recommendations appropriate for you. You should strongly consider seeking advice from your own investment advisor. Securities and investment advisory services offered through qualified registered representatives of MML Investor Services, LLC. Member SIPC, 6 Corporate Drive, Shelton, Connecticut, 06484. Telephone number 203-513-6000.